Okay, let's bring in Decio Nascimento, the CIO of Richmond Global Compass Capital. It's great to have you with us. And certainly the markets are reacting positively today on positive signs potentially of a détente between China and the US. But I want to take it back to some of the numbers we had out of China this week. Those PPI numbers came in deflationary territory, negative 0.8% year on year. And I was having a discussion with some people about whether or not the rest of the world should be more concerned about that, because essentially it means that China can now start exporting deflation to the rest of the world. That's worrying at a time when, ECB are trying to stimulate. Obviously, we've got a big meeting tomorrow.
Yeah, absolutely. I think important to keep in mind when we're talking about monetary policy that central banks around the world, they're setting policy 12, 18 months ahead of time. So China has been doing some fiscal effort and some monetary effort for a while at this point. So a lot of the data that's coming in more on the PMI side and on the expectations of inflation, they should start translating of what happened 12, 18 months ago, and especially the 6 months timeline when China started easing policy.
And in terms of where the narrative stands at the moment, from the Chinese side of things, it feels as though perhaps we're seeing a bit of a shift. I was just reading this morning in the South China Morning Post that reports suggest China is ready to sweeten the deal by buying more American goods. And then we've got this story about China releasing tariff restrictions on some goods. Do you think this is a true sort of a stepping back or a shift in narrative? Or is this just all about preserving what stability there is ahead of that October 1st anniversary that's so important in China?
Yeah, I think it's a combination of that, and it's really China modus operandi, right? They give you just a little bit so you can keep the conversation, but in the end of the day, I think it's very clear that China is not ready to deal with Trump. I think there is a higher probability than it's priced into the market that Trump's actually not even get elected next year. So China might be just waiting on that to actually make any effort to commit to a trade.
So that's a political calculation, but meanwhile, they have been injecting monetary stimulus. They cut the RRR last week, and we came in on Monday, and obviously markets had reacted positively to that. There has been a fiscal stimulus this time around, but much smaller than they've done in previous episodes. Are you seeing signs that that stimulus is actually having an impact on the Chinese economy?
Yeah, so a lot of the expectation indicators are still about to come and start showing some of those policies that were put in place a few months ago. So we haven't seen anything in the data yet, but internally at Richmond Global, we expect to start seeing an uptrend in economic data and inflation data coming out of China by the end of the year.
And in terms of the yuan, obviously a huge amount of focus when we saw the weakening earlier, just late summer. Do you think that that's going to come further into the fold as a potential weapon that China is keeping stashed away to try to combat an escalation in the trade war if we see that coming?
Yeah, I mean, this is a very bold gun for the trade war and the things that they're doing. It feels also a little bit it'll be shooting their own foot because they are trying to internationalize the yuan and make it useful for trade around the world. So in the end of the day, I think they will keep depreciating, but also in a band and keeping the volatility low so you can at some point internationalize the use of yuan.
Is this sell-off in fixed income, can it be wholly traced back to the fact that people are just nervous about whether the ECB are going to go big on asset purchases, or is there something else going on?
Yeah, I think the market's starting to realize that the ECB has to balance the costs of doing this kind of policy very close to the zero bound. So they're basically the main two channels, consumption and credit, they're already not working as well as the ECB would hope for. So on consumption, a lot of the consumption base in Europe is retirees. And when you're lowering to zero and negative interest rates, they don't have the income to spend. And then when you're talking about the credit channel with a very flat yield curve, banks are not making any money, and therefore, especially if you account for the fact that on the short end of the curve, there's some legislation that's possibly to be passed where banks cannot give you negative deposit rates. Now the curve becomes even flatter for banks, and they make less money, and therefore they lend less.
Is there some element of economic optimism as well? Just to pick up with our previous chats, you were talking about some positive signs essentially emerging out of China. Yeah. There could be, actually, in your words, a reflationary stimulus coming out of China towards the end of the year. Also, U.S. doesn't seem as bad as some pundits have been talking about. There's no imminent recession in sight. Is that one of the reasons as well why cyclicals are doing so well, to Juliana's point, why bond yields are moving higher as well?
Yeah, absolutely. So if you believe on the base case from the Fed, and then you take into account the monetary and fiscal policies that have been in place in the past few months in China, then the end of the year and the beginning of next year becomes much more bright.
Let's look in a little bit more detail at what Jumana just flagged there in terms of the cyclical rally we've seen come together recently, looking at some of the sectors that have performed really well: banks, basic resources, autos. These are the most unloved sectors in Europe. It's where a lot of the value plays sit, and it's been a sector that investors have really shrugged off in favor of the more defensive growth parts of the market. Do you think that the rotation we've seen has legs? Should investors be reconsidering their portfolio allocation strategies and chasing this rally into the unloved value cyclicals?
Well, in Europe is a little more complicated scenario because the curve is much flatter and it should stay much flatter, right? So if you think about cyclicals as a way to present your view on the yield curve, especially when you're talking about banks, then it becomes much more short-lived.
And in terms of the auto space, this is a sector, of course, that has suffered because of a slowdown in China. And just picking up on your more positive view of things there, should we see a boost to the auto sector on the back of a more positive China story coming through later this year?
Yeah, so I should also mention that I look a lot at sustainability investments. So this is part of our mandate. And it's really by having this diligent and organized way of looking at this that we also can have a better view on what's happening in the economy, especially in China with automakers. So the reason why automakers ended up underperforming in the past few months was because of the new rules in terms of CO2 emissions, right? So when you think about that and you're integrating this into your analysis, you're going to learn that there's really not a lot of upside for automakers because they will make sure that you cannot be putting too much CO2 into the atmosphere.
All right, well, we'll leave the conversation there. Thank you for all your contributions this morning. Decio Nascimento, Chief Investment Officer, Richmond Global Compass Capital.